You finally decide, this is it. You're going to start investing. You open an app, maybe scroll through videos, and suddenly you're surrounded by stories of people turning small amounts into huge gains. Someone made 10x on a stock. Someone else caught a crypto wave at the perfect time. It all feels exciting, almost addictive. And then quietly your brain steps in and says, if I'm going to do this, I need to do it right. So you pause, you don't invest yet. You tell yourself you'll start after you learn a bit more. A few days pass, then weeks, then months. And one day you realize something strange. You didn't lose any money, but you didn't grow any either, because you never actually started. That hesitation, that quiet delay, is the first investment mistake almost everyone makes. Most people believe the biggest mistake in investing is choosing the wrong stock, losing money, or entering the market at the wrong time. That's what scares them. That's what holds them back. But the truth is, those aren't the first mistakes. The real mistake happens much earlier. Before any money is even invested, it's the belief that you need to be fully ready before you begin. Ready with knowledge, ready with confidence, ready with the perfect plan. It feels logical, it feels responsible, but in reality, it creates a trap that keeps you stuck. Think about how it usually plays out. You hear about investing and feel a spark of motivation. You think, I should start doing this. But almost instantly, your brain starts listing risks. What if I lose money? What if I make the wrong decision? What if I don't understand how this works? And instead of starting small, you decide to prepare. You watch videos, read articles, compare strategies. You tell yourself you're being smart, but something unexpected happens. The more you learn, the more complicated everything feels. Now it's not just about investing. It's about choosing between stocks, crypto, real estate, index funds, long-term strategies, short-term trades, and suddenly you're overwhelmed. Your brain doesn't like too many choices, so it does what it's designed to do under pressure. It avoids making a decision at all. To understand this better, imagine you've never been to a gym before. Would you spend 6 months studying every exercise, watching tutorials, and learning about muscle groups before ever stepping inside? Probably not. You would just go. You'd start with light weights, feel awkward, maybe make mistakes, but slowly you'd improve. You'd learn by doing. Investing works exactly the same way. But because money is involved, we treat it differently. We treat it like a test we have to pass perfectly on the first try. And that changes everything. The reason this happens is psychological. Losing money feels painful. In fact, it feels more painful than gaining money feels good. So your brain tries to protect you. It tells you to wait, to be careful, to avoid risk. And without realizing it, you start believing that the safest thing to do is nothing. But doing nothing is not neutral. It's a decision. It's choosing to stay exactly where you are while time keeps moving forward. Here's where things get interesting. There are 2 ways to learn investing. The first is learning before taking action. The second is learning through action. Most people choose the first path. They think they need to understand everything before they begin. But investing doesn't work like that. You can't fully understand it without experiencing it. It's like trying to learn how to swim by reading a book. You might understand the theory, but the moment you enter the water, everything feels different. The fear, the uncertainty, the reactions, those can only be understood through experience. And this delay has a hidden cost. It's not just about missed opportunities. It's about something much bigger, time. Because investing isn't just about how much money you put in. It's about how long that money has to grow. Money grows slowly at first, almost invisibly, but over time it starts to accelerate. It compounds, it builds on itself, like a snowball rolling down a hill, getting bigger and faster as it moves. But that snowball only grows if you actually push it. If you stand at the top of the hill waiting for the perfect moment, it never starts rolling. Imagine 2 people. One decides to start investing today with a small amount. They don't know everything. They make mistakes. They learn as they go. The other person waits. They want to be sure. They spend time learning, planning, analyzing. 5 years later, the first person has something the second person doesn't: experience. They understand how markets move. They've seen ups and downs. They've built confidence. The second person might know more in theory, but they still feel unsure. Because knowledge without action doesn't create confidence. Experience does. This is where perfection becomes the real trap. People wait for the perfect time, the perfect strategy, the perfect moment when everything feels certain. But that moment never comes. Markets are always uncertain. That's their nature. And ironically, that's exactly why they reward people who are willing to stay in them over time. Waiting for certainty in investing is like waiting for calm waves before learning to surf. It sounds logical, but it keeps you stuck forever. So the first investment mistake isn't choosing the wrong asset. It's trying to eliminate risk before you even begin. And in doing that, you remove the most important factor in wealth building: time. Because time is what allows small investments to turn into something meaningful. Time is what turns consistency into growth. When you look deeper, you realize that wealth isn't built through perfect decisions. It's built through consistent behavior. Small actions repeated over long periods. The people who succeed in investing are not the ones who know the most. They are the ones who start early, stay consistent, and don't quit. They understand that investing is not about being right once. It's about staying in the game long enough for time to do its work. This leads to a powerful shift in thinking. Instead of asking, "What's the best investment?" a better question is, "How can I start learning with real money in a safe way?" Because your first investment is not really about making profit. It's about gaining experience. It's about understanding how you react to gains and losses, how you make decisions, how you handle uncertainty. That experience is far more valuable than trying to get everything right from the beginning. Another reason this mistake is so common is because of how we see successful investors. We look at people who have built wealth and assume they made smart, calculated, perfect decisions from the beginning. But that's not what actually happened. What we don't see are the early mistakes, the confusion, the small steps that didn't feel significant at the time. We only see the result, not the process. And that creates a false expectation that we need to be perfect too. But the truth is, every experienced investor was once a beginner who didn't know what they were doing. The difference is, they started anyway. They didn't wait until they felt ready. They became ready by taking action. There's also something else happening beneath the surface. When you don't invest, you stay comfortable. Your money sits safely where it is. There's no volatility, no ups and downs, no uncertainty. And your brain loves that. It feels calm. It feels controlled. But that comfort comes at a cost. Because growth almost never happens in comfort. Growth requires some level of uncertainty. And investing, by its nature, involves uncertainty. This doesn't mean you should take reckless risks. It means you need to accept that some level of discomfort is part of the process. That feeling of uncertainty when you make your first investment, that's not a sign you're doing something wrong. It's a sign you're stepping into something new. And once you cross that initial barrier, something interesting happens. The fear starts to decrease, not because the risk disappears, but because your understanding increases. You begin to see patterns. You start to recognize how markets move. You realize that short-term ups and downs are normal. And slowly your mindset shifts from fear to patience. This is why starting small is so powerful. It lowers the emotional pressure. It gives you space to learn without feeling overwhelmed. It turns investing from something scary into something manageable. And over time, that small start builds into something much bigger. Not just financially, but mentally. You also begin to notice a shift in how you think about money. Instead of seeing money as something to spend, you start seeing it as something that can grow. Every amount, no matter how small, starts to feel like a seed instead of just cash. And that shift in perspective is what separates people who build wealth from those who don't. Because wealth is not just about how much you earn, it's about how you think. It's about how you use what you have. And most importantly, it's about whether you give your money the chance to grow. The longer you delay that process, the harder it becomes to start. Not just financially, but mentally. The habit of not investing becomes stronger. The excuses become more convincing. And over time, "I'll start later" turns into, "I wish I started earlier." And that's a powerful realization, because almost everyone who has been investing for a long time shares one common thought. They don't say, "I wish I waited longer." They say, "I wish I started sooner." Another powerful thing that happens is that you become more aware. You start paying attention to things you never noticed before. Market movements, economic news, trends, things that once felt irrelevant suddenly become interesting. Not because you have to care, but because now you're involved. You have a stake, even if it's small. And that involvement naturally pulls you into learning more, but in a very different way than before. Before, learning felt overwhelming. There was too much information, too many options, too much uncertainty. But after you start, learning becomes practical. It becomes connected to real experience. You're no longer just consuming information, you're applying it, and that makes everything easier to understand. This is why the first step is so important. Not because it makes you rich instantly, but because it changes how you think. It shifts you from being an observer to being a participant, and that shift is where real growth begins. But there's still one more mindset trap that catches people, even after they start, and that's the expectation of quick results. In a world where everything is fast internet, fast content, fast results, We expect investing to be fast too. We invest a small amount and secretly hope it will grow quickly, and when it doesn't, we feel disappointed. This is where many people make their second mistake. They either stop investing because it feels slow, or they start chasing faster returns. They jump from one idea to another, looking for something exciting, something that moves quickly. But in doing that, they lose sight of the most important principle of investing: consistency over time. The practical takeaway is simple but not easy. Start small, so small that losing it won't scare you. Focus on consistency instead of perfection. Learn by doing, not just by watching. Accept that mistakes are part of the process, not something to avoid completely. Because every mistake teaches you something you can't learn any other way. At the end of the day, investing is not about timing the market. It's about time in the market. And the biggest risk is not losing money. It's never starting at all. Because years from now, you won't look back and regret the small mistakes you made. You'll look back and think about the time you lost waiting, the time you spent on the sidelines while opportunities passed by. So the real question isn't whether you're ready to invest. It's how long you're willing to wait before you begin. Because the moment you take that first step, no matter how small, everything changes. You're no longer just thinking about wealth. You've started building it.